All right. Hey, welcome back to the Go for CEO channel. This is John the Bomb. Building others means business. But today we dive deep into the world of business turnaround and financial restructuring with Jim Martin, founder and managing partner of ACM Capital. With more than 25 years experience restructuring companies across industries with combined revenues of exceeding of $3 billion plus dollars, Jim has guided organizations through some of the worst times and challenging seasons of their life, successfully restructuring over 1.4 billion in debt while creating sustainable value for shareholders. Jim's expertise spans leadership, M&A, debt placement, and organizational reform. But what truly sets him apart is his ability to bring clarity in the midst of chaos. Jim, welcome to the Go for CEO channel. How are you?
John, thank you. Thank you for having me. It's an interesting time to be talking about turnarounds and restructuring, right?
Oh yeah.
Uh, we see things all around us, from tariffs uh, to high interest rates, and so I come across companies today that are in desperate need of help, but some of them are candidly afraid to raise their hand.
Sure. Yeah. Well, there's a lot of pride in what you've done in creating a baby called a business, getting it to a certain point, maybe leveraging it to a point where you didn't realize it was going to put you in some trouble within 6, 12, 24 months. And all of a sudden, yeah, you're not raising your hand. So, well, we love to start with the beginning of the story, right? Just to make sure we understand, like, how was ACM Capital birthed? Where did your expertise come from? Some of that type of background, and then we'll kind of dive into your day to day and some of the things that you really have accomplished in your life. So take it away.
Oh, thank you. So my background I started in banking out of college, and back in the day, you had money center banks in Chicago, New York, LA. You didn't have interstate banking, or if you did, it was very limited. So I worked for a small commercial bank in South Florida, and I couldn't have picked a better training ground for my ultimate career, if you will, in that when I was at that bank, the bank was undercapitalized, but they had a group of guys who were young, in their early 30s, CEO, EVP, CFO, who were extremely innovative. They put a board together that was extremely innovative. So we were doing things in the 80s, late 80s, that was just that you just didn't see every day. I mean, we were the first bank on Fisher Island, let's say. We did we struck a deal with U.S. Customs whereby we would take the drug money that was seized on the open seas. We would count it at the U.S. Customs. We would then take it to the Fed. We'd hold it for the trial. And all the while we'd be earning interest. And back in the 80s, interest meant something. So I would send a couple of tellers to customs on the water, and they would count 5, 10, $15 million. We'd send it in a Wells Fargo truck, if you will, and to the Fed. And so that was pretty innovative. We also did SBA lending back in the day. And back then, you could securitize your SBA loans and sell them into the secondary market. So we did that too. So it was a great training ground. However, the bank was undercapitalized. So consequently, they hired a consultant, a turnaround guy. And he came in right just before 1990. And at the time, I was the only one that really had spreadsheet experience. And so he brought me under his wing, and candidly, I learned how to turn a business around, and from him. And so, he was successful. We were successful in turning the business around, raising new capital, and then we sold the bank. And so, really, my turnaround experience started in the, say, 92, 93 period. And I went into a bank, a holding company. After the bank was sold, one of the EVPs became a CEO of another bank in South Florida. They had purchased a company, a subsidiary that they had no idea what they had. So he sent me in, said, "Look, go figure this out. Figure out what we have, what we don't have. More importantly, what is our exposure?" So I did that. And we were successful in turning it around. And so at that point, I was brought into by a entrepreneur in South Florida. I was brought into a really tough situation in Eastern Europe, where a couple of master franchisees had raised money in the public markets, had planted the flag in Eastern Europe, and incurred a lot of debt in the process and had no idea how to get out of it. So that's really when I cut my teeth on restructuring debt and doing so in a post-communism world. So if ever one says, "Oh, but you have some experience," no, 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 I have street smarts as a result of that experience. Trust me. And so from there, I parlayed that into a successful run in Eastern Europe. I took, let's say, Burger King units that I was then in charge of, and it took them from 8 units to 25 units. And we had Domino's Pizza at the time. I took it from 3 units to 17 units, and sold it ultimately in 2000 to another master franchisee with different brands. So
Mm,
from that point on, I became a hired gun by private equity firms in the States. And I did that through 2008, successful throughout the process. But in the process, I came across the restructuring professionals. I came across them actually starting in 2000. And the restructuring professionals I came across were of the highest grade, the largest firms, and most importantly, the most expensive firms. So I learned what they could do, what they couldn't do, and what we were paying for, and candidly, what we weren't paying for. So
mm,
with that, as I said, I successfully turned around an aviation company after being the CEO in there for 6 years, 7 years actually. And it was right after 9/11. And I sold it in '08. And at the summer of '08, I saw where we were headed. And I realized that setting up a restructuring practice at that time with a fee structure that would allow the clients to share in the savings along with me. Meaning, if I were to go in and I said to a client, "Look, you've got 5 million of debt, you'll never be able to repay that. If I take that down to 1 million and we can restructure your balance sheet, then I would like to have X as a result of that." And so we did that, and we became super successful in that structure. It was never done before, candidly, that I know of. And so we continued to build on that throughout the period. I mean, we were in '08, at the end of '08. I was involved in an automotive tier two supplier in upstate New York. Automotive back in '08, at the beginning of the year, they forecasted 16 million units being produced in the States. At the end of the year, post mortem, the total production of units in the US was a little over 8 million. So just speaks
mm.
to just how precipitous the fall was, not just automotive as we know, but in every industry. So it was a great run, great structure to set up, and we've enjoyed success ever since.
It's interesting. You had these, stops, right, of, leading, of understanding, of growing, of creating momentum at certain levels, right? Going from three franchises to seven or that type of number. There's different complexities of areas that you were in and different industries. So let's go into some of the layman side, right? I think our Go Zero community is going to be excited to kind of hear some of those real tangible levers that you were pulling. So, in those beginning times, when you saw a business up front, based on some of the education and mentoring that you got, what were two or three areas that you were concentrated? Was it operations? Was it sales? Was it, expenses? Where did you start to go, okay, hey, here's where I need to pull a lever? And what time frames did that take?
Sure, great question. I'll take the last one first, expenses. And so early on, and this is what I had learned from this consultant I mentioned in the banking industry. Early on, I realized that particularly in the lower middle market, expenses were oftentimes they would run amok, and then the other thing that would happen is they were myopic. They being the owners of the business or the senior management of the business, and they were myopic in that they felt like, excuse me, if they could do certain things, they would get out of where they are, not realizing that the industry was about to turn, and the economy was about to turn, and the first thing they needed to do was to start to trim expenses, anything that was variable, or I should say anything that was fixed first. They needed to really take a hard look at, and start to trim that. As an example, in '08, I saw doing cash flow forecasts, and that's a tool, by the way, which is huge, is forecasting your cash flow ins and outs. I mean, essentially, it's a glorified checkbook, and forecasting that and realizing through that forecast and showing the management team through that forecast that you're gonna run over a cliff here, and if we don't do something now, you're not going to survive. So in the case of that automotive company, I started that in the early summer of '08, and we started trimming labor. And then we also implemented a health insurance program that was very it wasn't really popular, but it also wasn't very well known, and that was the high deductible program with an HSA component. This is '08, so they were just not known that well. And so those levers, if you will, between, doing insurance, also doing, reducing your labor, and doing some other things, enabled the company to move forward into a really, really tough period, with a very lean expense or lean budget, if you will. And so the levers are different. In Eastern Europe, the lever was more about getting the necessary capital in to grow the business, because the business, if you looked at it at the store level, it was profitable. They had layered in too many heads below. So that was easy to take out, but without additional capital, we wouldn't be able to grow it and therefore be in a position to bring in the right amount of management, if you will, to take over for the second half of the '90s. So again, levers are different. I've utilized operational levers. Here's a great example of that. We in the aviation company that I had, it was a heavy maintenance company. So we had about 500 and some odd mechanics, who touched aircraft. We would do commercial maintenance on 737s, 757s, 767s, MD-80s, MD-90s, the whole fleet of some airlines. And the labor on some of these aircraft was 30 to 40,000 man hours. So a lot of labor touching these aircraft. Now, we're in South Florida say at the time, 2005, 2006. And this is interesting as you come around when you hear this. I'm sitting there saying to myself, okay, we've got a lot of labor touching these aircraft. We don't really know where the subcontract labor is coming from. We've got a guy that's bringing in the subcontract labor with mechanics, but we don't know if they're legal. We don't know if they're terrorists. We don't know, really their backgrounds. And so at that point, I said, we should form our own staffing company, and we will be able to hire them. We'll be able to run background checks to make sure that they're legal, make sure they have all their I-9s, all their everything is properly documented. And what we'll do with that labor is we'll obviously utilize it within our facilities, but when we hit troughs, what we'll do is we'll sell that labor, to our competitors, primarily in the East Coast. So it was that, coupled with a few other moves where we got tough with some customers, that I won't mention, that enabled us to grow the business substantially, and ultimately sell it in the first quarter of '08.
So what a unique story there, right? You took a vertical within the business that you noticed and kind of took ownership of that, right? And then implemented a strategy to kind of grow that part, which then eventually really added value to the whole enterprise, right? Is what you're saying. So interesting. I think, in that lower middle market to middle market area, there's so many opportunities where you see a CEO, initially being kind of in the business and trying to think like, how do I get on the business, right? But then they get lost sometimes in that switch, right? Because they think they're everything to the business. They need to touch every single area, and you have leadership that starts to come in. So, in your perspective, or from your perspective, when you go into these companies, and let's say they have an org chart that's not as flat as it should be, probably, where do you start to pick out the talent that makes most sense to keep, and where do you start to pick the talent that, like, hey, this is either we could add more to their plate so that we can adjust the other staffing. What is that formula to you, and how do you start looking at that?
That's a great question. It obviously, I mean, it goes without saying, situations are vary drastically, right? From one company to another. Excuse me, some companies require a pretty strong management team, both middle management and senior management. Others don't necessarily need that type of management structure. But I'll tell you a funny story, or not a funny story, but something that I've learned over the years when I've stepped into a company that's in some form of distress. The first person that comes into my office and starts telling me about other people in the organization without me even asking the question is the first person I terminate.
Yeah.
Right? I mean it, and I've done it multiple times. But then the next thing, when you're stepping in, and let's pick founders and second generations with founders, and let's talk about founders bringing in friends and bringing in people they've known all their life, thinking that it's more trust than anything else. That's the quality that I need. I, being the founder, I need somebody in whom I can trust. And what I've learned and what I've tried to explain to some founders over the years is that that trust starts to melt away, and you'd be surprised at what gets done behind your back by those same people in whom you trust. Secondly, as we have found out painfully, I think many times, the second generation of the founder is not necessarily as passionate or as diligent as the first generation. And so you've got dynamics involved here that really prohibit, or not prohibit, but it prevents um, the founder and his management team from making moves because of this layer that they've put in place, that they find almost impossible to remove. So impossible to remove because I now have some of my family in there. Impossible to remove because I have some people that I've known all my life. And so that when I step into situations like that, I oftentimes will tell the founder, listen, you got to step aside as far as looking at what we need to do as a business to survive. If so and so needs to go, they need to go. You cannot have sacred cows. Or if you want to continue to play that game, you're going to run off a cliff.
Mhm.
So, it's really, it's tough love. That's where, I mean, I can't stress that enough. It's tough love, and those founders or entrepreneurs that listen, that get it, and really, check their egos, are the ones that have been the most successful when we've turned a business around.
That's a really interesting story, right? Like, you see companies out of Japan that last 300, 500 years. And in America, we've got this, weird situation where second and third generation, it's almost unheard of by the third generation, unless some sort of PE or company like yours, and, you start to restructure and put in some new blood and the right type of talent to share that. So, it's an interesting thing, and so many different reasons, like you said, complacency. That first founder has that grit that they have in them. The second person comes in and maybe that lifestyle was good, so now the business becomes a lifestyle business instead of an actual business, right? And there's a lot to be said to that, and I think there's psychological things, there's mindset thing, right? That you really,
Cultural.
yeah, cultural things. So, let's stay on it just a little bit because I think it'd be nice to kind of go deeper. So, in those situations, are you seeing, just to kind of give people some hints that may be tuning in today, right? Are you seeing when there's two or three friends on there, they also have the great cars that are being paid by the company? I've seen 18 Cadillacs on some spreadsheets in my day. Or is it that the trips to certain places are company expensed, and there's garbage in there that is not true business expense? Are they treating the business? Is that what's getting them in trouble, or is it they just have people that don't know how to run that specific division or that business?
Yeah, I mean, great questions and follow up. I mean, in the case of friends that are spending money, if they're part of the management team, they're enjoying all the perks that everybody else is, right? So they're getting those cars, they're getting those travel allowances, they're getting those trips, as is everybody else. I've seen, and in fact, in one case, I warned the CEO who brought in a high school friend. Now they're 20 years removed from high school, but he brought in a high school friend to serve as his CFO. That high school friend, took him for $500,000,
Hmm.
right? Pure theft. I mean, just forget theft through expense, padding your expense statements. This was pure theft. And I warned him early on. I said, you cannot. The thing with a smaller business, particularly as you run into, murky waters, is that there has to be a level of controls in that company that prevent things like the CFO stealing from you, from happening. And I just had this conversation yesterday with a client and their CFO, and they have poor internal controls. They have poor control over cash and dominion over cash. And what I say to them and what I've encountered over the years is that a CFO, let's say, has signing authority on the banks. They can wire funds. They can do it all individually by themselves. There is no callback feature. There is no second signer. If there's a second signer, excuse me, the second signer is not necessarily the CEO. It could be other people by convenience, people that they know are going to be there every day. And so they put the check in front of them and say, here, sign this. I got to get this paid. So it's really putting in the discipline and the controls, to help you prevent theft and prevent, misdeeds, candidly, in these businesses. And I've seen it so many times, and also larger businesses. I mean, a company the turn of the century, I stepped in and they had a payables clerk who, she could put in an invoice in the system. By the way, this is a $280 million company, had been around for 150 years. She could put an invoice in. She could select that invoice for payment. Oh, excuse me, let me back up. She could actually create the vendor, put the invoice in, select the invoice for payment, and then they had a facsimile signature system for any checks from 5,000 and below. All it required was you print the check and you had a facsimile signature. And she would send these checks out to cronies around the country. And so she took the company for over $500,000, that's $750,000 at the time, by doing just this type of scam. Well, of course, speaking of scams, I mean, nowadays the level of sophistication is through the roof. But the point being that you've got to have, controls in place, and the friends and the family that you've put in place, you can't give them carte blanche. You just can't.
Yeah. I'll put on my banker hat right now because, gosh, I feel the goosebumps because I've heard these stories, I've seen these stories, and I could see where, I work with a lot of fractional CFO companies. They're great referral sources for me on my day-to-day business dealings. And, when you bring in that third party from a 5 million or 7 million or $13 million company or what have you, it's interesting to kind of have that third party come in, take a lens at where the financials are. What are the control systems? Is there dual signer on an account? Is there any, you know, um, treasury management tools that they're not using, right? ACH, payables and positive pay, these things that from a banking perspective, it's normal for a banker to kind of think of, but from an owner perspective or CEO or a founder and putting a team together,
Cumbersome.
yeah, they start to go, well, I don't need that. That's $42 a month. And yeah,
Right.
$42 a month, but it's 400,000 of savings that potentially could have happened.
That's right.
Just
Yeah, no, you're spot on. You're spot on. And again, by the way, when I said that I couldn't have started my career better than being in banking because I learned all facets of banking. And we had fraud cases in banking. We had secretaries who had worked for, let's say, a law firm for 30 years who was able to forge signatures of the partners so well that the partner could not tell whether or not the signature was valid or not. And so we had that. We had, I mean, just you name it. It ran the gamut. So the problem is so often, and you mentioned, owners and others, kind of poo-pooing the idea of having these controls in that are candidly from a banking, from your banking relationship, they're virtually no cost. Um, but when you look at the damage that these things can do, I mean, it's limitless. It really is limitless. And that's when, you talk about fractional CFOs and others, third parties that come in that for whom the owners and founders and CEOs, et cetera, respect, it makes a world of difference because they will listen to what the third party is seeing. And more importantly, they will listen to the adjustments or to the additional controls that are needed to be put in place. And so that's a critical, critical piece of a restructuring or a turnaround.
Neat, neat. So, look, I'd love to take us in a direction where, you had this, background and the mentor, and then you were placed in certain areas. You went to Europe and learned a ton, but when it comes to ACM Capital, like if you think somebody's out there saying to themselves, hey, I'm a banker, I want to become this, or I want to do this, or, I'm in a certain field and I just have a passion for being able to turn around operations or turn around marketing and turn around these things, right? It's all kind of a similar concept. What was some of the things that you structurally put together to start ACM? And then what's some of the ways that you charge? It sounded like at the beginning you said there's an equity play, right? A rev share equity. If you turn around, you get a certain percentage, and then you get to kind of leave that business running and humming at a good pace. So what are some of those ways that you start?
Yeah, so what I ultimately did was I started to hire and put in place different disciplines than mine. More operationally focused, people that had been in the operations, strictly in operations. And case in point, I hired a guy who had gone into um, the maintenance company I told you about in aviation, and would observe how the mechanics touch the aircraft. And by the way, it was a 24/7 shop. So he would observe in the middle of the night and observe in the middle of the day, how the mechanics were going to, let's say, the stock room and taking the parts out and bringing them to the aircraft. And what he learned, I mean, again, this is just one of so many examples, but what he learned was if you stage the parts across the aircraft for the guys that come in first thing in the morning, you're going to save an hour and a half, arguably, of touch time, right? By doing that. And so you're going to improve labor efficiency uh, exponentially as a result of that. Just that move alone. So I started bringing in people that were much smarter than I, that had far greater experience than I did as far as operations were concerned, and putting them in a position where they could succeed. And the same thing would happen. And by the way, everybody that I brought in, every professional that I brought in, or have brought in to my firm, they share in the upside. This is not a salary. I don't believe in that. I believe in bringing people in that make a difference, and I'm happy to share the wealth. I mean, it's the only way to go. So, you bring in these disciplines that perhaps are if you look at the spectrum of skill sets in a business, I may have touched certain areas, or I may have overlapped certain areas, but I don't have the pure expertise that some of these guys do. And again, I would bring them in. I mean, I did that with salespeople. I did that with salespeople that would put in Salesforce and put in other tools and mechanisms so that we could take a company that was really doing poorly on follow-ups and leaving a lot of revenue potentially on the table, by really streamlining their CRMs and instituting discipline with the sales team, to make sure the CRM was always up to date, and that there was a constant follow-up and all the things that are necessary to execute, on the top line.
Hmm. You bring up little areas like that that are so essential, and I think, from a either lower management or kind of frontline people, you think, well, this is kind of a nuisance, right? Why do I have to put in my every call? But there's always details and data that comes back, right, that you can analyze, because without it, you're kind of just lost in the whim of things, right? And don't know what direction to head and what lever to push. So it's really interesting dynamic. So I'm interested to, how did ACM develop its, revenue stream from a conceptual side of like, hey, did you start off with an hourly fee? Did you, say to yourself, okay, hey, I've made, sounded like, you had some great success before. So then ACM, was that mostly a equity play each time? So you were willing to kind of do the labor that it took to get to that level? What's that structure for you?
Yeah, great question. When I started, the first thing I did was I hired two guys who had about uh, they had about 6 to 7 years of experience in public accounting,
Hmm.
or with an advisory shop like an Alvarez and Marcel or someone like that. And I brought them on and I put them on salary, paying them 25% more than they were getting paid where they were, but promising them that, if they worked as they were working before, but if they worked in this lower middle market sector, they would be incredibly successful. But more importantly, they would leave my firm ultimately. I mean, I'm a realist. They would leave my firm with a skill set and value that would be unmatched. And I'm proud to say that both of those guys left. One left after 4 years with me. The other one left after 7 years with me. And both of them left to large consulting firms. One was McKinsey, the other one was Alvarez and Marcel. So, I felt good about that. But to answer your question, I would bring in talent that I could bill for. In my
Hmm.
case, I would bill a bit hourly, but I had a much higher rate. And I would tell my clients, that rate is deserved, that rate is earned from the years of what I've been able to achieve. However, you can't afford that rate. And so therefore, we will do something different. We will do a fee share, or excuse me, a savings share. We'll do an equity share, debt restructuring, whatever the case is. And so when I look back at the most successful years that the firm had, we were very successful in restructuring debt. In one case, I had a high net worth individual who had an $18 million personal guarantee with
Mm.
a top three bank. And I was able to get that $18 million whittled down to two. And so what that did was it freed up his assets to create a new company. So it varies, but it's for me. And by the way, and I'm sure you're going to ask this question, but I might as well say it now. Uh, Communication is key. And you can appreciate this being a banker. I have come into so many companies where the communication with their lender, when they start to get in trouble, they go silent with their lender. And that's the last thing you should do. You need to keep them informed at every step. And so in the case of this high net worth individual, fortunately for him, he continued the dialogue with the lender, but he didn't have the sophistication to go in and understand what the lenders, while they had a personal guarantee, they had, for the most part, they had written off that debt. So they were putting immense pressure on this guy. But when I stepped in, and of course, knowing that the other side of the negotiation table, I was able to successfully show them that, that unsecured guarantee, while damaging to my client, is just that. It's an unsecured guarantee. So let's really look at it for what it is. Let's figure out a way that we can get you guys some money, and reduce the charge off, and at the same time give my client another day to live.
Hmm. It's interesting. I think people that listen are listening would like to go a little bit deeper on that because it's I have a understanding of it, right? But if you think about someone hears, oh, they owe $18 million, and they're pretty well off. So as a personal guarantor, you wrote your signature to say, hey, I'll take care of it if my company doesn't take care of it in that scenario. So it's not non-recourse, right?
Right.
So in that scenario, what are some just high level things? And maybe you don't want to give away too much of the trade secrets, but would love to just go deeper in the sense that are you going to the bank and saying, hey, come on, guys, like I know that there's a write-off period, there's a seasoning of this, and are you talking to them about just, hey, wouldn't you rather, instead of spending 3 million in lawyer fees, et cetera. So my guy's, worth this, he could fight that. But are these the conversations, or is there something even more simpler that we're missing?
Yeah, no, because remember, most of the time when I'm in that situation, I'm dealing with the bank's, put this in quotes, special assets group.
Hmm.
And so these guys are typically seasoned, and they know their way around the bank, and more importantly, they know their way around financial statements. And so they're looking, look, they didn't make the loan, right? If they can recoup money, particularly from a guarantee, they look like heroes. And so knowing that when you're walking in is a key piece. But then when you get in, and you need to understand the players on the other side, you need to understand who you're speaking with, and then what the communication channels are upward, and what the sign-offs are for an approval of a forgiveness. And so those are key pieces that you've got to understand. And at the risk of sounding like a salesman, um, most of your clients do not understand that and will never have the skill set to do that, with special asset group professionals. Just won't. So, it varies, as we know. But in some cases, that the lender's got the owner and the business, pretty well. I mean, he's got a firm hold on what he could do from a foreclosure standpoint. And in other cases, he doesn't. and he knows he doesn't. And so in those situations, sure, they could get a judgment, but how I mean, in some cases, the borrower's judgment proof, right? I mean, let's say they live in Florida and they take all the money they have and roll it into a residence, right? I mean, and all of a sudden it's a different picture. So, you need to understand the nuances of from the banking side, and understand what the leverage is that they have, and what the pain points are.
And look, there is a dynamic of storytelling in that, right? From a banker perspective, I'll just put my hat on. We're always kind of sharing, hey, you know, we're building a relationship. There's, a personal guarantee on this. We typically will not do non-recourse, meaning go for CO community that that person that's signing on it, they don't have any personal liability on it as a non-recourse.
Right.
But it's interesting, as you described it there. There's things that, as a bank and this division of the bank, they already know that they've done this, write off, or there's some tax advantage that maybe they're playing out at the greater scheme of it. And as a professional, why you came in there, you're able to kind of hit on those, pain points, right? Even from the bank side compared to the client side. So it's interesting. Anything else that you'd want to share from that perspective?
Yeah, so I think, what's interesting too is I've dealt with hedge funds who have large debt funds, and they're senior lenders. So they effectively step in the place of a traditional bank. And so a lot of it also depends on the time of the year, right? So if it's a hedge fund, and they're in constant fundraising mode, right? So, but in the case of a hedge fund that's a senior lender, let's say, um, the end of the year is a great time to negotiate with them, right? They want that off their books. It's non-performing. It's been non-performing. Same with lenders. The time of year is also a very important factor.
Yeah, it's when you're public as an example, right, and you're announcing quarterly earnings, there's always a timing factor of when you want to declare certain things. So interesting.
Exactly.
So awesome, awesome. Well, Jim, what a wealth of knowledge. Obviously, there's many different components to business. You've chosen an area that is really, it's kind of like maybe equated in a sense to criminal attorney, right? This dynamic scenario that is in a situation and you got to get them out of it, right? Obviously not to the level of, murder and stuff like that, but it could be very tumultuous, right? You've got to almost be a bartender accepting stories, and a psychologist with this person, right? So there's so
Yeah.
many different dynamics that you have to deal with. So I really appreciate you sharing with the Gulf Show community. So we like to end our interviews with CEO, right? So client experience, E is for engagement, and O is for operational excellence. So let's start with the first one, client experience. From an ACM Capital perspective, somebody's looking at your website, they just heard this, they're like, man, I'm in a little bit of trouble. I'm an $18 million company. We owe 4 million. We're at 4 times leverage or 17 times leverage, whatever it may be, some crazy number. And I need to get to hold of you. What could someone expect from a client experience journey with you guys?
Sure. So oftentimes it's me that will take that call, or will go out and visit the potential client. And I say to people that are in that position today, do not hesitate to call, do not hesitate to reach out, and ask for help, or at least ask for somebody to come out, talk to you, understand your situation, and allow them to come back with a potential plan. Doesn't cost you anything. In fact, I mean, in my case, it doesn't cost you anything. I would never charge on the front end like that. What I would try to do is say, look, here are the pitfalls, here are the challenges that you have, and here's how I think you could get out of it. And so I think, to people out there that have some issues, and look, I think it's going to get tougher, candidly, before it gets better, out in the industry. But I say to them, don't hesitate to reach out to a professional. Hopefully that's me. Hopefully that's my firm. And we will be straightforward and honest. You brought up at the very beginning, clarity to chaos. Um, well, the chaos, you described it just a minute ago. It's most of the time it is chaos. Most of the time there's some chaotic things going on. And so just that initial assessment, that initial meeting, you start to bring clarity to them so that they can see it through a different lens.
Yeah. Yeah. And take a step back, right? I'll be selfish here. My book, The 4A Formula, talks about chapter one, assess. If you don't start with that, you really have no place to go, right? You have to take that time, write down some realistic things that are going on, assess where you're at, bring in a guy like Jim and really evaluate where you're at. And it could be life and business, right?
That's
Uh,
right.
it's your five F's: your faith, your family, your fitness, your finance, and your fun. In business, it's operation, scaling, leadership, dynamics, funding, all that type of stuff. So just selfish plug there. It's a great book, and it talks about that structure of how you could do it in your life and business. So, second one is E for engagement. A lot of times people are like, you look at someone and they have that aura. They walk into a room and you know that they're present, they're there, right? Um, you know, it seems like you've been able to kind of be at the right place at the right time with the right mentorships, with the right leadership, and all those type of things. What are some of the things that you do to engage with people that you bring into an organization, clients? And I mean engage like, are you a big golf guy? Do you like to, take people out on retreats? Are you a gift guy? Like, do you like to give little gifts at birthdays? What are some things that you do to engage? Because it's such an important and missed aspect sometimes of human interaction.
So the best example I can give you, Jonathan, is what I've done with clients over the years. And I early on in an engagement, I will take the management team out off site, take them off site for a couple of days, and I will bring in, let's say, from my business school, strategy professor, or if it's operationally centric in that particular company, I'll bring in my operations professor or a operations professor that isn't from my business school. But I would bring in third parties that with whom we would spend a considerable amount of time. And at the end of the sessions, we would have all of that management team determine what the best strategy is for the company going forward. And I can't tell you how beneficial that has been to my clients, to their management teams, and their ultimate success. The other thing that I do to engage is that with the management team, I will oftentimes force them to present every Friday where they are, what they're doing, and do so not just verbally, but do so with a PowerPoint, with actual details that are on paper, if you will. And they're presenting that to the entire team with follow up for the following week. And so, what does that do? Well, it's accountability, it's communication, it's making sure that the various departments are aligned, or if they're not aligned, how can they be aligned? And all of those things bring information, critical information to your management team. And then you'd be amazed at how you start to see the engagement from them to other departments that perhaps they haven't engaged as much in the past.
No, it's interesting, right? And again, I'll say chapter three is accountability. It's amazing how you're putting it together there, right? And so proud of the book. And it's a simple 120-page book, but it's interesting how the dynamics of everything that you just shared, that assessing, aligning yourself with you and the team, then taking accountability. It's all about looking in the mirror. The last one's action. So, but now organizationally, from ACM or even some of the things that you suggest into companies that you take over and work with, what are some operational tools that you can give us a clue on? Are you into this AI movement, or are you more traditional? Are you, like you mentioned, spreadsheets earlier? What are some of the tools that make your business and others operationally excellent?
Okay, I have to start with this, and it sounds so simplistic, but it's so critical. I implement a one-page front and back flash report. if the company is operationally centric, then the data on that flash report is heavily focused on operations. So what does that mean? Downtime on machines, scrap, um, inefficiency with your labor. And so obviously every flash report is different within each company, but those flash reports either go out daily or they go out at least weekly. So in the case of a retail operation, let's say, I will have them put in their sales for the day, but the sales compared to the same day last week, same day last year, right? Sales, COGS, etc. So information flow for operational sake is absolutely critical. And so that's the biggest tool that I implement right away. I'm doing it right now, by the way, with a company that with whom I became engaged recently, and they have periodic calls. I said, no, 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 we're going to have weekly calls, and we're going to have weekly calls with a flash report, and everybody on that call is going to know everything that's on that flash report. And by the way, we're going to take your data that you're sharing periodically, that's 5, 6 pages long, and we're going to condense that to a front and back. Now, whether you do it, through a PDF, whether you do it, I mean, the mode is not as important as the method, and also the data, the underlying data. As far as AI is concerned, I have not utilized AI as much as I'd like to, or as much as I don't fully understand the benefits of AI for the clients that I have today. And so I know that's kind of a pass on an answer, but it's as candid as I can be.
No, I love it. I mean, look, we're all in this kind of ramp up period. A lot of gurus out there are starting to do webinars and seminars, kind of with a little bit of a fear factor, saying, "Hey,
Right,
if you get on this, you're going to be lost."
right. That's right.
There's a little bit of 1998, 1999 internet drama going on right now. Uh,
Yes,
but there's also an awareness that, look, these things are unlike anything we've ever seen. I know for me personally, I've already kind of dumped, I'm 15, 20 hours already learning like how to create an agent, an AI agent. And, you set up the brain of it with these different components. And I learned yesterday, there's really only 5 platforms like OpenAI, you know, um, uh, Claude and whatever. Let's just call it 5 platforms that every other cool new AI thing, they all go through these 5 platforms. It's kind of like, I remember selling long distance service back in the day. There was AT&T, US Sprint, and blah blah blah.
right.
Right. So
That's right. No, that's right.
interesting times that we live in. But no, I appreciate the candidness, and I'm sure that you, as a company, and as a even some of these operational things, there is some components to it that it could alleviate with the speed that now AI can do and gathering that data and stuff. So
There's
so
no
just
doubt. One thing and I don't mean to cut you off, but real quick, I remember back in the day in business school, I remember a professor saying to us, listen, technology is not a game changer for you and your company. It gets you in the game. Technology will get you in the game, and I think AI is the same way. It's a ticket to get in the game with which to compete in the marketplace. Ultimately, I don't know if it is today, but again, that's my ignorance more than it is the reality today.
Yeah, I mean, look, we can talk another hour on. I had a few AI guys I just interviewed recently, and they're younger guys. They're in their 20s, so they're like in the midst of everything. As we get older in our 50s and 60s, right? We sometimes think, oh well, if it ain't broke, don't break it.
Right.
But there is some components to that. So, all right. So Jim, tell people if they're excited to work with you and they're in that situation right now, what's some of the ways that they can get a hold of you and connect with you.
Sure. So, you can find us on acmcapitalpartners.com. My email address is my first initial J, my last name Martin at acmcapitalpartners.com. And also, I always tell people my cell phone is working 24/7. So feel free to give me a call. My cell phone is 305-978-0720. I will pick up every call, and I'll talk to you. And if it's a 30-minute chat that helps you with guidance, I'm happy to do it.
Awesome. Well, Go for CEO community, what a great mind to have on our channel today. Experience, wisdom, and in the game right now, right? Not in the stands, having said, hey, this is all the things I did. He's in the game every day, working with that lower middle market companies that are, in these situations, right? I think one of the biggest things that he said too is don't stay silent. Don't go MIA. Don't be a prisoner of war. Like get
That's
out
right.
of your own way and
That's right.
open up the lines of communication with your banker, with your consultant, those types of people to be able to get you out of these binds and work with someone that can see the forest from the trees when you're in a chaotic state. So awesome, Jim. Well, thank you so much for coming on the Go for CEO channel. We look forward to having you on in the future sometime as
John,
well.
thank you. And the best of luck to you and with your book, and very, very, very exciting for you. So thank you.